Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news. And of course, to have the weekly news, we need to have Nick Bendel here, which thankfully he is here with us. Welcome, Nick.
Thank you. I got the memo and I am here.
Fantastic. I hope you brought the news as well. But before we find out that, what have you been up to in the past week?
Well, I've been up to no good as always, but
Of course.
I did have a very nice week. My business, Hunter and Scribe, we write content for mortgage brokers throughout Australia. So I always go along to mortgage broking conferences and PD days. And last week I attended SFG's annual conference at the SCG, which was really enjoyable. There were quite a few clients of mine in the room. I also chatted to quite a few brokers who didn't yet realize that they were going to become clients of mine.
Of course.
Yeah. I really enjoyed the educational presentations as well. For those who like cricket, Glenn McGrath was there, which took me back to my childhood. Ned Brockman also gave a really interesting presentation, and there were some other good speeches. So it was a really, really good day.
Right. So you had Glenn McGrath at the SFG conference at the SCG.
Yes, we did. And the crowd actually, we were led in a chant of Glenn McGrath, not by Glenn McGrath, I should point out, but by Will Lockett, the head of SFG.
Oh, fantastic. And try saying that line 5 times quickly. A bit of a tongue twister.
It is a bit of a tongue twister, which is why I'm not going to do it. Well, what did you get up to the past week? And actually, just before you tell me that, am I imagining things, or do you have a different backdrop this week?
A bit of a different backdrop, yes, at the moment. And so just here in not so sunny Hobart, and someone needs to tell them that it's almost summer as well, because it's I feel like I've gone back to the middle of the deep, dark winter. But been here for a few days, bit of personal and maybe a bit of business. You never know in the short to medium term future, but always on the hunt for new opportunities. But yes, here in Hobart, be back in the next couple of days, and looking forward to getting warm again. But it's Hobart's quite nice. But other than being here, we've been busy work-wise, still leasing quite a bit. And funnily enough, we haven't spoken about Adelaide too much lately, but we're starting to see a bit more activity in Adelaide with new properties coming on for management in the Adelaide market. So good to see a bit of activity in the past week or so with that. So just thought I'd make mention of that. So if anyone does have a investment property in Adelaide and they're not happy with their property manager, here at Leafield, we can certainly help you with that.
I'm very glad you've talked about property management and different rental markets, because 2 of the 3 stories we've got coming up are covering those very themes, and I'm looking forward to getting your expert take.
Can't wait. So on that note, let's get into it. Have you brought the news this week, Nick? Let us know.
Yes. Let me take it out of my pocket, and there we go. The first story is property investors coming out in force. A total of 57,624 investment loans were issued in the September quarter, which was 13.6% higher than the previous quarter and the most since March 2022, according to the Australian Bureau of Statistics. Investor loans represented 40.7% of all loans in the September quarter. Back in March 2022, it was just 34.3%. Property Investment Professionals of Australia Chair Kate Bakos told the Australian Financial Review that the sharp rise in investor activity would concern regulators. They'll be concerned about negative impact on owner-occupiers and, in particular, first-home buyers, she said. If investor activity continues to climb and becomes a threat to the pace of growth of housing opportunities for owner-occupiers and first-home buyers, we would certainly see tighter macro-prudential restrictions. Bakos, though, said that would be a mistake. Strangling credit is a bad thing all around. It's not healthy. We've already seen a lot of investor-led sales in the marketplace. So, Owen, what do you think? Well, sorry, why do you think investor borrowing activity has risen so sharply?
Oh, there'd be a number of reasons, Nick. Firstly, a lot more buyers agents out there in the marketplace who are focused on in investor markets, and that's led a lot of property investors seeking out value in the market. And so, with a lot more buyers agents who are out there looking at value investments around the country. And we've seen that the property investor these days is a lot more mobile in terms of where they're looking at to buy. And so that's one reason, and as well as the stability of interest rates, it's given a lot of confidence of as well as the couple of reductions that we've had this year, and it's given a lot of confidence in the market, especially for investors to go out there and invest, and which is a good thing because it puts more supply into the market for renters. So the more supply in the market for renters, then we will see rents slowly, stopping from increasing as greatly as we have seen in the last number of years, which I think we've already started to see that in the marketplace.
Whenever the share of investor borrowing increases, inevitably people raise concern that this is coming at the expense of owner occupiers, particularly first-time buyers. So I'm wondering, should we be concerned that investors are making up an increasing share of the market?
Not at all. Owner occupiers have the same opportunity of getting out there and competing with investors to be able to buy those properties. So there's no issue there. If owner occupiers want to buy a property, they can compete with everyone else in the marketplace to be able to buy that property. The good thing is that if an investor does buy a property, then it puts more supply into the market to be able to help investors who renters who are trying to find a place to live. And one more property in that market will help give more supply, which means rents won't go up as quickly as they have been.
Back in 2014, APRA was concerned by the rapid increase in investor activity, and as a result, they told lenders they could not grow their investor lending books by more than 10% per year. Kate Bakos from Pippa has raised the idea that regulators might look for tighter macroprudential restrictions. Again, she said that would be a mistake. But I'm wondering, do you think if investor lending keeps increasing, that APRA might consider new macroprudential restrictions?
They might do. I don't necessarily think it's a good thing that they start fiddling with market forces. That being said, we've got some of the best regulated banking system in the world, and which has got us through the GFC in a healthy state. And so as a result, it's probably not a bad thing for APRA to always be looking at these things. But in times of trouble, like during the GFC, they had to make certain decisions. But since then, we've been plodding along fairly well. So for them to start getting out there and forcing the banks to do one thing or another, I don't see APRA really getting too involved at this stage. There's not any sort of red flags really popping up to really warrant anything like that.
So your message to APRA is look, but don't touch.
That's a good summary, Nick.
Okay, well, I'll pass it on. Thank you very much. Let's move on to our second story today. Supply struggling to keep up with demand in rental market. Despite the surge in investor activity that we just discussed, the national rental vacancy rate held firm at 1.2% in October, according to SQM research, and that was the same as both the previous month and the previous year. The capital cities with the highest vacancy rates were Melbourne at 1.8%, Canberra at 1.4%, Sydney at 1.3%, and Brisbane at 1%. In the other capitals, vacancy rates were 0.8% in Adelaide, 0.7% in both Perth and Darwin, and 0.4% in Hobart. The national vacancy rate holding at 1.2% suggests the rental market remains very tight, with little sign of meaningful supply increases, SQM Managing Director Louis Christopher said. Overall, we expect rental conditions to remain tight through the summer months, with only a modest increase in vacancies likely in early 2026. Now, Owen, these figures that I've just mentioned from SQM, they cover the entire country and the capital cities. Your property management business, Leafield, operates at a local level in 5 different states. Are all those suburbs where you're operating, are all of them landlords markets, or are you working in some suburbs where tenants have the upper hand?
Oh, yes. And we need to understand that all markets at some stage will have higher supplies than the demand can fill. So markets fluctuate from time to time, week to week, even month to month. So it all depends on the level of supply and demand at that stage. But there are certain markets in the country that have sustained long-term supply, especially in newer markets. So, for example, in Melbourne, there's a couple of areas in the western and eastern corridors of growth. For example, in the west, there's Wyndham Vale. In the eastern suburbs, there's Pakenham. And then there's also a lot of the units in the inner city of Melbourne where there's a lot of supply. And there is, in those areas, you may be looking at weeks, even up to months, to be able to get your property leased, unless you want to drastically drop your price, and which some owners are having to consider. But most of the time in most markets, as long as you're asking a fair market price for your property, you're getting your property leased pretty quickly. And that's like within 2 weeks at the maximum. So yes, it all depends on the area. There's some areas of Perth that are oversupplied with rental stock. And in Brisbane, there can be some areas from time to time that can have that. But in general, most properties in most areas are getting leased fairly quickly if priced properly.
A pretty good rule of thumb is if the vacancy rate is between 2 and 3%, the market is in some sort of balance. If it's above 3, it's a tenant's market. If it's below 2, it's a landlord's market. I mention this because the national vacancy rate has been under 1.6%, i.e. Very much a landlord's market since the start of 2022, so almost 4 years now. Why has the vacancy rate, again, that's the national vacancy rate, why has that been so low for so long?
Or a number of factors, but in basic, to come back to supply and demand, we don't have enough properties being built, and with a lot more demand. So the demand factor has been driven by the high levels of immigration that we've had coming into the country in the last number of years. I think we've covered off that in a number of stories in the last couple of months. But we need to see a drop in that immigration levels in the next couple of years while we're catching up on the supply side. Now, the reason why we're not having the supply side increased as much as we would like to is for a number of factors. But one is the increased cost of materials to be able to build. and the increased cost of labour with trades to be able to build with those same materials that have gone up in price. So you've got a lot of developers who are not necessarily willing to take that risk of trying to build new properties because the cost might be more than the property is worth at the end of it.
You
And that's
made
our biggest problem.
you made a very interesting point. So usually when in any market, when demand is high, that triggers a supply side response. Various suppliers come in and think, well, if demand's high, I can cash in by bringing my supply to the market. But as you're saying, while one might have ordinarily expected a supply side response from developers, you've explained why developers have been reluctant to build despite the very low vacancy rate. So at a
Yes.
time when we've had strong demand, we've had limited supply, and I guess that's kind of exacerbated, as you say, the very low vacancy rate.
Yes, absolutely correct. And so it's this issue that I know the New South Wales government has come out to try and help with giving a government guarantee to help the supply side, to be able to help developers get these projects off the ground by guaranteeing purchases at a certain level so that they can get their financing. Now, we need that to be able to get that supply kicking through, because otherwise, we won't see the number of properties being built that we need to, and it's those main two factors of increasing in costs and of materials, and then increase in labour, because the amount of immigration we've got coming in, we haven't got enough of those trades coming in to be able to help feed that supply issue of trades.
You're really going to love our third and final story today, and I'm very curious to get your thoughts. Trump floats idea of big, beautiful mortgages. The
Oh,
federal
woo.
The Federal Housing Finance Agency in America has said it is working on a proposal for 50-year mortgages after Donald Trump raised the idea in a social media post. When Trump was interviewed on Fox News about the idea and was told it was upsetting his base, he replied, "All it means is you pay less per month. You pay it over a longer period of time. It's not like a big factor. It might help a little bit. If you took out an $800,000 loan to buy a $1 million property, and if your interest rate was 5.5%, here's how your repayments will look over both 30 years and 50 years. So your monthly repayments would be $4,542 over 30 years, or $3,919 over 50 years. That would be a difference of $623 per month, or 15%. Your total repayments over the life of the loan would be $1.635 million over 30 years, or $2.351 million over 50 years, which would be a difference of $716,000 or 44%. Owen, what do you think of the idea of a 50-year mortgage?
It sounds like a huge number to be able to pay off your home loan in 50 years, but it doesn't really matter. I mean, what it will do in practical sense is make it easier to qualify for your loan, and it'll mean that you can borrow more as well because you're paying it off over a longer term and your repayments will be lower. That's really the only practical benefit of having a 50-year mortgage, or anything over 30 years. Because 30 years is really the maximum that we can have at the moment. So when it comes down to it, and what the regulator would look at and what the banks would look at, is that they would really only be looking at being able to lend you more money, or just make it easier to be able to qualify for the loan that you want. So it's one or the other. So that would be the really only practical benefit of having a 50-year mortgage.
So do you think it would be a good thing or a bad thing, or neither? It would depend on a case-by-case basis.
Yeah, it's a case by case basis. So it's it's in a practical sense, it's I mean, in the first three, yeah, especially the first 2 years, but even up to the first 5 years, you're paying mostly interest anyway with your principal and interest repayments. So it would mean that your repayments would be a little bit lower each month. So it'd be saving you on that cash flow, make it easier for those to for those first few years to be able to keep your repayments. And but again, in practical purposes, the average life of a loan is between 3 and 5 years. Now, some people might be outraged in terms of understanding why that would be, but it's for two reasons. People refinance every 3 to 5 years, and people sell on average every 5 to 7 years. So people don't get a 30-year mortgage and then sell after 5 years and then have a 25-year mortgage. They take out a new mortgage for a further 30 years. So it's really just continuing to recycle that 30-year mortgage every 3 to 5 years that happens. So it really doesn't make a big difference. If someone wanted to have the best structure, I mean, it really comes down to their circumstances. But even if you had an interest-only loan for, say, the first 2 or 3 years, that would give you some cash flow benefits, which would mean that it would make it easier when you first get into you, especially for first home buyers. It would make it easier because you'd be saving, a few $100s a month, and to make it easier as you're getting used to having a mortgage. But then for the remainder of that 30-year loan, you'd want to amortize the whole loan over that sort of 27 or 28-year mortgage that was left. And so that you're still paying it off in those 30 years, but just have those first couple of years. So that would, I think, would be the most practical loan structure for especially first home buyers. But maybe anyone that's maybe upsizing into a bigger mortgage, that would be a smart idea. But the only practical reason for having a 40 or a 50-year mortgage is if you want to be able to borrow more, or to be able to qualify easier for the loan that you do want.
Okay, so you've raised a scenario in which this is neutral. A person takes out a loan, whether it's 30 years or 50 years, and then the loan closes out after a few years, either because they refinance or sell, in which case it doesn't matter if the loan was 30 years, 40 years, or 50 years. That's a neutral scenario. You've raised a positive scenario in that people who might not have been able to qualify for a loan now can, or people who might have had a lower borrowing capacity now can borrow more. That's a positive scenario. Let me throw a potentially negative scenario at you, which is if now people can qualify for 50-year mortgages, then you're going to have more people qualifying for loans and more people qualifying for larger loans, and therefore people showing up to auctions with more money in their pocket, and therefore you're adding even more demand to the market without increasing supply, and therefore you're just pushing up prices. Would that be a negative scenario?
Yes, that would be a negative scenario, but no worse than, say, giving a government guarantee for only a 5% deposit.
Oh, okay. Now we're getting controversial. Let me ask you this: should APRA or the government ban 50-year mortgages in Australia, or do you say just leave it to the market to decide?
I don't think there's any point in banning it. Do we really need it? Yeah, not necessarily. I think especially with having, as I just brought up, the 5% government guarantee deposit, um, and for first home buyers, but that doesn't help people who aren't first home buyers, and they need to be able to qualify for a higher loan. Um, if maybe if it's a lower LVR, maybe it has to be under 80% as a loan to value ratio to be able to qualify for that. There could be certain minimum requirements. But I don't see any reason why you couldn't have that. But again, it's almost like, well, what's the point? You might as well just have an interest-only loan for the
Hmm.
first, 3 to 5 years. It would be, almost the same thing, because more than likely that loan will be paid out and through refinancing or sale anyway.
We are coming up to our 2-year anniversary for this podcast. So we're almost due to refinance this podcast.
Oh, I maybe, but I don't know if it might be a bit early, Nick. I don't know. What are you
Well,
thinking?
let's wait until the clawback period ends and then let's have a chat about it.
Yes, maybe we need to speak to our favorite broker, but yeah, do we really have a favorite broker? That would be like trying to pick a favorite child, wouldn't it?
Exactly, it would. It would. No, we love them all.
Yes. And yes, love yous all, as they
Love
say.
yous all. Thank you, Owen. Thank you, Jeff Fennick. Great to chat as always, and see you next week.
Yes, see you next week, Nick, with of course, the weekly news. See you then. Bye.